Okay, so now let's try to understand about discounting of notes receivable with a real world example. So there is a company whose name is IBM Corporation. Now IBM holds a 6-month note receivable from a customer with a maturity value of $120,000. It means that on maturity, after 6 months, IBM will receive $120,000. Now IBM endorses the note to a bank. Basically, it gives the note to a bank without recourse to receive immediate cash. IBM will be receiving cash from bank immediately. Now the bank applies a discount rate of 6% per annum. On an annual basis, bank applies the 6% discount rate. Now we need to calculate how much cash we will receive basically, or IBM will receive. So we know that on the maturity, the value of the note is $120,000, which is given here. Now the discount rate is 6%, but this 6% is for per annum, and we need to calculate it for 6 months. So 6-month basis, the discount will be 3,600, which will be deducted by bank. So effectively what will happen, the cash which IBM will receive is $116,400, and this is the net amount which will be received by IBM immediately. Now the key points to remember here is like discount of 3,600 represent the bank's charge for providing cash before maturity, because bank is giving you the money pre-hand and before 6 months, so definitely they are charging you something. The discount allows the holder to convert notes receivable into immediate cash, improving liquidity. Simply IBM went to the bank and they got the money immediately, so this is helpful for liquidity. And finally, the notes can be discounted with or without recourse, affecting the risk retained by the sellers. So basically, without recourse are primarily concerned with the bad debts. So some sell the bank their notes, ensuring that the bad debts will be borne by the bank, or some are sold to the bank, ensuring that the bad debt won't borne by the bank, the bad debts will be borne by the company or IBM itself. So that depends upon whether it's a with recourse or without recourse. And for this concept, we have already studied the previous sessions. We have studied the concept basically. Now let's see the textbook concept or definition of these discounting of notes receivable. So basically we know that the definition of discounted notes receivable occurs when the holder, which means IBM, endorses a note to a third party, that is giving the note to a third party with or without recourse in exchange for immediate cash. IBM is getting immediate cash. The mechanism is simple. The cash received by the holder is calculated by a discount rate, which is like the cash received by holder, meaning the IBM, is calculated by applying a discount rate, in our example 6%, to the maturity value, in our example $120,000 of the note. And finally, the difference between maturity value and the cash received is recorded as discount. In our example, the discount was $3,600, which bank recorded. The purpose, why do we use it? It allows the holder to convert notes receivable into cash. Basically, IBM got the cash immediately, so that is helpful for IBM. And before the note maturity, note will take time to get mature in the 6 months. So IBM needs the money as of now, and finally they go and discount this notes receivable. Now let's talk about the risk and liability. Depends on whether the discount is with recourse or without recourse, that is with bad debt or without bad debt. And there are two types which we have already talked, with recourse and without recourse, and for them we have already discussed more in the factoring discussion or session.